Hello everyone, welcome to this video Accounting 210. In this video, I want to talk about Chapter 9, the master budget. I will post my the handout to the blackboard, so I'm not really going to read everything, but I want to point out some key parts with you. So let's get started. First, when talking about some concepts, you should be able to know what's the meaning of budgetary slack and then the benefits of a budget. So those things, read textbook and then get a general idea. We focus on talk about the master budgets. You know what's the meaning of master? So it's comprehensive for all of overall the company. You have two sub category. One is the operating for your daily operation. So after you finish your operating budget, you will get your budgeted income statement. And then the next one is our financial budgets. So once you get your financial budget, you should be able to get your balance sheet budgeted. So I would say make sure you know the flow of our everything. So this is the master budgets. We always start from sales budget. So the top is our operating budgets. So you will get your income statement once you do your operating budgets. And then you do your financial budgets, you will get your balanced sheet from your financial budgets. So make sure how do we get everything. And then I basically talk about why everything is linked. Sales budget is the start point, the start place for the budgeting. So we have to always start from our sales budget. So basically telling about what's our revenue dollar amount. What is our revenue dollar amount? We budgeted we will sell 30,000 units. Each one is $20. So we'll get $600, 600,000, 400,000, 500,000. That's 1.5 million for the first quarter dollar amount. Then you will separate your sales, right? Your sales has two parts. One is cash sales, one is credit sales. I just assume you already know everything in this semester, so I jump here and there. I don't just read the handout. So for the cash sales, you will collect 120,000. You will collect 120,000 when you make sales in January. But for your credit sales, you do not collect the money in that month. The question will tell you, the question says, hey, cash sales is 20% of the rest, which means 80% will be credit sales, and your collection is, maybe 60% the next month, 40% in the next month, something like that. So you will collect your cash for your credit sales in following month, but your cash sales, the 120,000 will be collected in January. Okay, so that's I say when we have our sales budget, we can do our cash collection budget. So I'm on page 10. And then remember, we have a cash sales 120,000, 80,000, 100,000, 300,000. So that's your cash sales. That is your cash sales. So you collected that amount of sale in the same month. And then we said 85% will be collected your collection of that month contains 85% of collection 1 month ago and 14% of credit sales 2 months ago. So we now look at March, okay? I'll show you the example of March cash collection. Okay, March cash collection, that month you collected 100,000 because you had a cash sale 100,000. And then it said 85% of credit sales 1 month ago. So your March, 1 month ago of March is February, right? So that will be our February. I'll just write it here. 2 months ago of March will be your January. So your January credit sales, 14% of credit sales. So your focus is only on credit sales. 14% of your January's credit sales will be collected in March. Our January credit sale, our January credit sale is 480,000. Okay, so our 14% of 480,000 January credit sale will be collected in March. And 85% of credit sale made 1 month ago, which is February, will be collected in March. Our February credit sale is 320,000. 85% of credit sale made 1 month ago, which is February, will be collected in March. So 85% of February credit sales, 320,000 will be collected in March. So your March collected 20% of your March sales, which is your cash sales. Cash sales is 20%. So your March collected 20% of your 500,000 total revenue sales. So your March collected 20% of the sales as cash. And March also collected 85% of your February's credit sales, 14% of your January's credit sales. So your total March cash collection is 20% of your March sales, 85% of February credit sales, 14% of January credit sales. So your cash collection is 439,200. That is your cash collection. But your March sale is 500,000. You say, hey, why my revenue is different from collection? Because we sell on credit, because you have account receivable. When will you receive? Based on your collection budget. So this is the first part. We made our sale budget. We link our sale budget with our cash collection budget. So make sure you know those connections, okay? So we talk about company, they said 20% will be sold as cash. So that you got 20%, and 80% will be credit sales. And then you collect your credit sales from different amounts. Okay, so next part, then we talk about production. So you thought, hey, you will sell 30,000 units, then how many units you have to produce? Now we make our production budget. Production budget, we said, it started from the units you want to sell. So you thought, hey, January, I'm going to sell 30,000 units. And now you will have your ending inventory. Your ending inventory is 10%, 20%, 15%, you have to read the question. But some percent of your next month's sale will be your ending inventory. So for this question, is 10% of your next month's sale will be your ending inventory of this month. So we are thinking about sales of the units, okay? So January, you are planning to sell 30,000 units. February, you are thinking about selling 20,000 units. And you want 10% of your next month to be this month ending inventory of your production. So you have to need 32,000 units. But 10% of your this month, your 10% of this month will be the beginning inventory of your production. You subtract your beginning inventory, you get units you have to produce. We said for the quarter, January beginning inventory will be the beginning inventory of your first quarter. March ending inventory will be the ending inventory of your first quarter. Okay, so that's the production budget. It's related with our sales. And once you got production, then you can do direct material and direct labor and then manufacturing overhead. So I'm not going to repeat, but for the direct material, you said, hey, January, you have to produce this much, and then each unit you need 5 pounds of material. So totally, you need to produce is 145,000 pounds. And you need the next month 10% as this month ending inventory. You need 10% of this month as your beginning inventory of direct material. Now because on direct, focus on direct material. And then you do that kind of, so you get your purchase price for 1 pound, you get your direct material, the total budget, we have to spend that much money. Direct material is about, detailed, but direct labor is kind of straightforward. You want to produce 29,000 units, and then each one use like a 0.05 hour, each hour pay $22. So that is the direct labor you want to do. Remember the direct labor, we said we have to be, sorry, I forgot this one, but I'll go back there. For direct labor, you said January, you will spend use labor by 31,900, February, March, and the quarter. So that money you have to pay the employee directly, right? So when we do our direct labor budget, we also is related with our cash payment. Remember later when we did our cash payment, we said direct labor, remember, is 31,900 because you estimated you will have this expense and all of them has to be paid. So you have to be paid 31,000 the same amount. And remember for the direct material, we estimate that January you will have direct material cost $211,125. February it will be $157,650. But we said for direct material, we also give 30 days to pay. So we pay it January. We need to spend the money, but we don't make a payment until February. February we got the material first, but we don't pay until March. So for like that, right? So you link your direct material budget to your direct material purchase of a cash payment budget. You link your direct labor budget to the cash payment of direct labor. Okay, and then we said manufacturing overhead, also nothing too much. Basically, you have all the variable manufacturing overhead, you have fixed manufacturing overhead. Sorry about that. So I did all of the calculation. I didn't do textbook, did all of the calculation. So you have January manufacturing overhead. You thought, hey, will be this much, this much, this much, and then your total will be this much. But do we really need to pay them? And once you get this income statement, right, when we do our production budget, we will get our budgeted income statement. So that is your expense. But expense doesn't mean we have to pay because we have account payable. Sometimes we get this inventory, but we don't make a payment until next month, right? So also we said some part are non-cash, so we have to do an adjustment. So we link this manufacturing overhead budget to cash payment budget. So if you remember, January is 102,500. We go to all the way to page 12. Then you have a cash payment for your manufacturing overhead. We said, hey, you thought it will be 102,500. Remember that is our overhead expense. So this is our overhead expense. And then we just copy 102,500, 81,250, blah, blah, blah. But when we do our cash payment, we have to make an adjustment. First, we decrease the depreciation because that's not a cash expense. It will never show in our cash payment budget. From the table, you found out the depreciation every month. you added 10,000 as the expense, but they are not cash, so you have to add that 10,000 back. And then for the property, you allocated every month has to be 3,000. You allocated, said, hey, it has to be 3,000. That is our property expense. That is our insurance expense. You know, remember every year you do journal entry, hey, debit direct expense, insurance expense. But that's not our cash payment. We pay our cash twice a year. And then, so every month we first deduct that 3,000, that is our expense, but it's not cash payment. And then for January, we made a cash payment of the first 6 months, which is 18,000. So your January, you subtract another 18,000 as cash payment, but now you have to kind of add, right? So you minus this, plus this, because this is your cash payment. So you adjust from your expense. You subtract a non-cash item, you subtract a non-cash item, you add your cash payment for the first 6 months of property and insurance. Okay, so you adjust that, you get your cash payment for your manufacturing overhead. And then once you do that one, we also have our operating expense, right? We have our operating expense. You do the similar, you say, hey, it's your variable cost, it's your fixed cost. And then we did our variable cost, fixed cost. The main thing you need to know is we have one expense called bad debt expense. Bad debt is because our credit sale. So it's 1% of our credit sale. It's only related with the credit sale. Cash sale will have no bad debt expense because you get your cash immediately. Bad debt expense is only related with your credit sale. So remember, you have a 480,000. We said 1% is bad debt you will never collect. So you got 4,800 bad debt expense. So you do all this, you get your January, February, March, and then you get all of the operating expense. And now we want to get our cash payment. We want to say, hey, do we pay all of these expenses the same month? Then you adjust from that expense to our cash payment. We said it's 142,800, 106,200, blah, blah. We copy from there, we get our budgeted expense, right? We got our budgeted expense. Then we said, hey, some expenses are not related with the cash. First thing is depreciation. Second is bad debt expense. Those are non-cash expense. They have to be subtracted from your cash payment. So you get your cash payment for your operating expense. Okay, so this is how do you link there, everything there. Then once you get everything, you can prepare for your budgeted income statement. You have budgeted revenue sales, you have your budgeted cost of goods sold, you get your per unit there, you get your gross profit, you minus operating expense from your operating expense budget, and then you get your operating income, you minus interest expense, and then you minus income tax, which is 35%, you get your budgeted net income. Okay, so that's the first part, and we found out that they are actually related with your cash payment. Your sales related, your credit sales is related with your cash collection. Your credit sales is related with your cash collection, and all of your expense, budgeted expense are related with your cash payment. Okay, then you said, hey, there are some just small items you want to say about related with the cash. One is called the capital expenditure budget. You thought that January you want to buy a new one, the printer, equipment. So January you will spend 125,000 on the capital budgeting. So you that will be paid with the cash. February, March, you don't have any capital expenditure, so you don't need to worry about that. Talk about cash collection, it's related with our budgeted sales, and then you all have this payment. So after all of that, you have this cash payment budget, right? You have this cash payment budget. So you have payment for direct material. Remember, we did that for direct material. Your January is paid February, February is paid March. So that is your direct material. Direct labor, you pay the same amount. Manufacturing overhead, it's adjusted from your manufacturing overhead expense. You adjust for non-cash part, and then you subtract, you add all of the payment for your insurance. You have the operating expense cash payment adjusted from the expense. You adjusted for the non-cash part, which is depreciation expense and bad debt expense. Capital investment, you got this number from your capital expenditure. January, you will spend 125,000 to buy material, to buy long-term assets. February, March is 0. So you have 125 February 00 for March and February. You have your cash payment for income tax. You don't have it until April. So first month is 0. You have a dividend, you will pay 25,000 in January. So your total cash expense payment, sorry, I should say cash payment is January, February, March, like that. And then I think we just talked about that. Finally, you will combine everything, so you have a combined cash budget. So we talk about that later because we didn't cover that one, so we talk about that later. But you can find out your operating budget, actually those things, your operating budget, they are related with your financial budget. As I said, your cash expenditure is related with all of these expense. Your cash collection is related with your sales. Okay, I know it's a lot of things. I hope you can feel better after doing the practice. So always let me know if you have any question. I'll see you next time. Thank you.